Hello and welcome to this MithrilMoney Securities Investment 101 lecture on free float stock. Now this is lecture 007. I was hoping that this lecture would be bonds or the start of bonds, but that's going to be lecture 8. Anyway, let's get on then with free float stock. So what are we going to talk about today? Well, the first thing we're going to talk about is what free float stock is. So what is free float stock? And then we'll move on to our second topic. How is that calculated? How is free float stock calculated? And finally, at this point you're thinking, well, I'll just move on to lecture 8 on bonds. But no, stick around, because free float stock is important. We'll figure out why it's important. So why is free float stock important? Why do we need to know about it? Okay, let's crack on then. Let's start with a company. So here's a company here, and we'll call it the MithrilMoney Fish Sauce Company. Now, we need to break down this company into two types of stock. There's going to be free float stock, basically tradable on a regular basis on an exchange, let's say. So it's freely tradable by the public. Free float stock is sometimes called public float stock, which probably gives a better clue to its name. It basically means it's stuff which is regularly traded by the public and which isn't held by large kind of owners. Now, what do I mean by large owners? Let's break down this company. Let's put one large owner in here, and this large owner owns 10% of the stock, and this is one of the founders of the MithrilMoney Fish Sauce Company. This is me, this is Andy. So Andy owns 10% of the company, and he is a founder of the company. So he's going to be classified as a large owner, and he's going to be in non-free float stock kind of territory. Let's have a look at another founder of the company. There are two founders of this company. So the second founder is going to be Sean. And Sean owns 15%. I know that's not an accurate representation. I should have made that a quarter, shouldn't I? Let's not worry too much about that. So this is Sean. And Sean owns 15%. He's a company founder, and again, he's a large owner. Anyone more than 5% is a large owner, and they're said to be outside the free float stock, non-free float stock, because, you know, as a founder and owning such a large amount, Sean's probably going to be holding on to this for a long time, and he's not going to be regularly trading it the same way a kind of derivatives trader would be doing on a day-by-day hedging basis, 1 or 2% of the company. Let's take a look at another kind of large owner. So there's founders, two founders. Another kind of large owner might be, say, a pension fund. So let's put a pension fund in there. So we've got a pension fund in here, and this is going to be the Hubble Bubble pension fund. And let's say that they own 9%. So let's give them 9% of the company. There we go. Again, over 5%, another large owner. Therefore, we're going to put them in the non-free float category. Let's put another kind of owner in here. This might be a value investor, somebody who's buying and holding for the long term. Pension fund might be buying and selling for 20, 30 years, but a kind of hedge fund or a value investor might hold for a couple of years. They might have bought low and they're hoping to sell high on the fundamentals. So let's put them in too. So 10%. So 10% is owned by the MithrilMoney hedge fund. So 10% owned by the MithrilMoney hedge fund there. Again, over 5%. Therefore, what we're talking about there is non-free float stock. Now, what about anyone who's under 5%? Can they be in the non-free float stock too? Yes, there's two major groups who are in there. The first group might be, let's say we have given some stock to some of the employees. So as founders of the company, what we've done is we've given, let's say, 4% of the stock. We've given it away to the employees. So 4% there we've given to the employees. Now you think, well, employees might just be buying and selling this stuff. Why are they different from the public? Well, the thing about this stock is that this is restricted sale. So they cannot sell this stuff for 5 years from the time that they're given it. And this is to encourage them to stay with the company for 5 years. So because they can't sell it straight away, that's also going to be in the non-free float stock. And what other kind of people are going to be in here as well? One last major group. What we'll do is we'll give 3%. So we've got that little slice there. That little slice is owned by the CEO. So the CEO of the company executive officer, and this is Penelope. So there's Penelope there. And she owns, let's give her 3%. So Penelope owns 3% of the company. Now, she can sell this, she can buy this, she can sell this. She's not restricted like the employees are. Let's just put their time frame down. So this is 5 years before they can sell this stock on. But she will be probably on an insider list. So typically a lot of exchanges around the world, even where the government hasn't interfered with the free market and brought in compulsory insider lists, a lot of exchanges will say things like this. Anyone who's a major kind of corporate officer is going to have to be on a special list. Let's just move this across here. The reason why is because we've got lots of traders over here who use our exchange, and they're buying and selling, buying and selling, buying and selling. They're using our services. And what we don't want to happen is we don't want them to be manipulated by trades that Penelope here does as the CEO. As the CEO, she knows lots of important things about the company, so she could theoretically manipulate the share price. So to protect these people over here, who are kind of customers of the exchange, we'll have an insider list, and there will be restrictions on insiders. If the company wants to trade itself on this exchange, there will be restrictions on Penelope about when she can buy and when she can sell that stock. And this is to protect these people here. So all of that stuff there is going to be held to be non-free float stock. Let's just add up the numbers. So we've got 10, 15, 9, 10, 4 for the employees and 3 for Penelope. If we add those numbers up, 25, 34, 44, 48 and 51. So that all adds up to 51% so far. Now, typically in most parts of the world, not every single part of the world, because the non-free float figure is an estimate, we'll typically round that up to the nearest 5%. So let's just round that up to 55, just so we make sure that we're absolutely capturing it. So we'll just add on 4% there just for fun. And now we know our free float figure. So the free float figure is going to be everything in here. So that's going to be 45%. I'll use a bigger colouring in stick. There we go. So everything in that yellow zone is going to be free float stock. So everything in there, free float stock. And that's 45%. So we just have a little bit of wiggle room here. So there's just a little bit of wiggle room here. That's that extra kind of 4%. That's a kind of buffer there. So we'll just label that. We'll just label that as a buffer. And that was from this rounding up kind of gig that was going on here. So that's what free float stock is. And again, you're thinking, well, I'm sorry, I still don't particularly care. Why do we like this figure? Well, this stuff here is being traded by these people on a regular basis. It's going round and round and round the secondary market like a kind of washing machine. And it gives a good reflection of the kind of sentiment, the market sentiment as to the company. The other stuff, all the other coloured stuff on the right-hand side of the diagram here, that's all being held maybe for the long term, or it's got restrictions in some way, or we're assuming it's being held for the long term. So it's not kind of reflecting the kind of market sentiment of all these people here. This is the market. And all the people on the right-hand side of this diagram, they're kind of insiders in some way, or restricted people in some way, or founders in some way, or large holders in some way. And their shares are essentially in a vault. So we have a vault over here. And all those kind of multicoloured shares that we have, the non-yellow shares, are all kind of in this vault here. And so we're going to assume that they're locked up. So we like the yellow stuff because it gives a good representation of the company, and even better than that, we can invest in the yellow stuff. So if I come into the marketplace over here, actually we'll have to make this my cousin because I'm already on the diagram, aren't I? So this is my cousin Vinny, and I haven't phoned him up. I haven't told him anything down the phone. I haven't given him the result of the boxing match ahead of the boxing match, and he wants to invest. What can he invest in? Let's just get rid of these figures here, kind of getting in the way there. What he can invest in is he can invest in the yellow stuff. So that's why we typically want to know about the free float stock. Now, the other reason is because index construction companies, such as, say, actually, it's probably better if we just quickly redraw this. Hopefully, you've kind of got all that. Let's just quickly redraw the company. So what we've got over here is we've got 45% is free float stock, and 55% is non-free float stock. Let's just colour the yellow stuff in. There we are. So the yellow stuff here is what's used by index construction companies to construct their indexes. Now, if we take a look at the total market capitalization of this company, so the total market cap of the MithrilMoney fish sauce company, the share price was $10, and we're going to multiply that by the number of shares, which is 1,000, which gives us total market cap $10,000. Now, you might think that global index constructors would use that as the weighting for any indexes they're constructing, but they don't use it typically. Most major global equity indexes will use this weighting, and that weighting is going to be 10,000 multiplied by 45%, which is going to be a weighting of $4,500. So that's the weighting they will use for the MithrilMoney fish sauce company in any kind of index they're publishing. So let's say that MithrilMoney fish sauce company is in the Straits Times Index as one of the 30 largest companies in Singapore. Well, that will be the weighting that we get inside that particular index produced by the FTSE company. Okay, now why is that interesting? Because there could be an announcement by FTSE on Bloomberg, let's say. So you read it on Bloomberg, that what's happened is everybody on the right-hand side of that diagram there, that 55% has sold their shares except Andy. There was an AGM which unrestricted the employee shares. The insider sold her shares within the rules. Sean kind of cashed in and got out of the company, concentrated on the MithrilMoney hedge fund. The MithrilMoney hedge fund then immediately sold all their shares. Probably Sean knew something that he didn't tell me. And everyone else got out. Now, all that was left was Andy with his 10%. So that's still non-free float. But all the other stuff has come onto the market. All the other stuff has come onto the market, so the non-free float stock is now 10%, and that figure has changed to 90%. And this will come onto the kind of the Bloomberg News features as the weighting goes from 0.45 to 0.9. And what that will do is that will double the representation of the MithrilMoney Fish Source Company, or approximately double it, on the Straits Times Index, because MithrilMoney Fish Source Company hasn't changed in size at all, but the weighting has changed, so it's now doubled its representation on that particular index. So we have to be very observant of news items like this if we're investing in sort of indexes. There is a secondary kind of use for the free float kind of total as well. Again, it's typically exchange driven. So let's draw our exchange again. So here's our nice shiny exchange, and here's all of its traders on the exchange, and they're all buying and selling, buying and selling, buying and selling. And we have a rule on the exchange that every company that trades on this exchange must have a free float of at least 25%. Now, why do we insist on this as exchange owners? The reason why is to give these people some liquidity. So we need a pool of liquidity. Imagine this was a swimming pool. Okay, it's a 25-meter swimming pool, so 25%. It's a 25-meter swimming pool. So let's just draw a quick swimming pool here. So it's a 25-meter swimming pool. Can those 4 people fit inside that 25-meter swimming pool? I would say so. There's plenty of room in there. There's plenty of liquidity. If they want to go for a swim, they can go for a swim. There's probably plenty of room in the sauna as well. So there's plenty of liquidity there for the 4 people, the 4 traders who regularly trade in the MithrilMoney Fish Source Company over there. Now, if that should shrink, if the free float kind of total should shrink, let's imagine that it shrinks down to a measly 5%. Then there's a lot less liquidity for our traders, isn't there? There's only a 5-meter swimming pool now, so all of this has been roped off for children's lessons. And our 4 traders are now all bobbing up and down in here, and now they're a bit sad because they're lacking liquidity. In fact, there's so little room, I can hardly squeeze the 4th one in. All the children are splashing around in this 20-meter pool section, and our 4 traders are jammed into that kind of shallow end there, and they can hardly swim up and down. Now, because there's so much less liquidity at this point, there's a bit of volatility. They start fighting each other. Some of them start swimming into each other and banging each other's heads and teeth and tongues and so on. So there's a bit of volatility, and it gets a bit fractious in there, and everything gets a bit tough. So if there's less liquidity, less volume, there's less ability to buy, there's less ability to sell, there's going to be higher volatility, and higher volatility, particularly if you're, say, leveraged, can lead to dangerous situations in trading. So we want to be careful about the free float figure for that reason. All the other 95% is locked up in some way. So the exchange insists on at least 25% to protect the ability of its clients, its traders, to have some kind of liquidity. So all the children have been sent home, and these 4 people can now swim about, and they're a lot kind of happier now. Let's get rid of this unsmiley face. Oh, got rid of the pool. Hopefully you can cope with that. So they can all swim around now. So they're much happier with this much liquidity in the MithrilMoney Fish Source Company. The other thing we need to think about, of course, is that, yes, there is a bit of selfishness from the exchange, because as people are buying and selling, there are fees involved here. And if there's enough, plenty of liquidity, then MithrilMoney Fish Source Company will be a good target and a good vehicle for people to use for their trading operations. And so the exchange will be getting plenty of fees. There are 2 circumstances where, again, we need to be careful here, because sometimes exchanges can relax their rules on the free float and liquidity for 2 major kinds of organizations. So let's remove this analogy here. That what they might do is, if there's a new young company coming onto the marketplace, a lot of those shares might be tied up in this new young company. Let's say this is the MithrilMoney New Zealand Air Service company, and Andy and Sean both want to keep, let's say, they both want to keep 40% of the stock. Because they like this company, they want to kind of benefit in the growth of this. So at the moment, they can't put it onto the exchange because they only have a 20% kind of free float that they want to kind of sell in an IPO. But the exchange says, no, for a new young company, yes, you can come onto the exchange and we'll give you a limit of, say, 15% for your free float, just to encourage you to come onto the exchange in the first place, which is nice. But after 2 years, you will have to get up to that. And Sean and Andy say, that's fine, we'll grow the company, then we'll cash in a bit and get to the 25%. So the exchange here is kind of doing seed development and is kind of providing itself with future companies which can be traded on the stock exchange. Most organisations, of course, including government organisations, last about 40 years. I mean, government departments will get kind of dissolved and restarted. There are some companies which are very old. I think there's an iron ore mining company in Sweden which is 400 years old, and treasury departments inside governments can last a long time. But the typical life of any organisation is about 40 years. So the exchange constantly needs to be helping new organisations to come onto the exchange. The second case where we need to be worried about a small free float, which brings with it high volatility, just think, there will be high volatility in this company. One, because it's small and it's new, and two, because of this limited free float, which gives us that tiny swimming pool of small amounts of liquidity. But there is a second thing we need to be careful of. I want you to imagine 3 highly successful and growing companies and one moribund old giant company which has seen better days, which really is become very, very moribund. Now, in a true free market, this is what would typically happen. Joseph Schumpeter's kind of forces of creative destructionism will bankrupt this company because it's not serving its customers or the market very well anymore. And what will happen is it will be broken up in bankruptcy courts, and all of its kind of resources that it was hogging will go off in bankruptcy court proceedings, and all the good stuff, although it's been malinvested, all of the good stuff will be snapped up by these thrusting new enterprising companies, which will grow because they've soaked up these new resources and they're using them better. And so that company will grow as well and serve the market better and serve customers better and serve society better. And this company managed to suck up all of these malinvested resources in the bankruptcy court, snap them up, and it's going to grow as well. Oh, just try and grab that again. It's going to grow as well, fantastically. And this company will disappear. And all of these companies, these thrusting new enterprising companies which are serving the market really well, will do really even better than they did before. And the whole of society, which I'll just represent by me, will be happier because we're getting 3 better services rather than 1 bad service and 3 small services. So that's how the true free market is supposed to operate. Unfortunately, we don't actually exist probably anywhere in the world inside a true, absolutely true free market. So what tends to happen these days, particularly in the Western world, is there's 3 upthrusting new companies. Here's 1 moribund company, which really should go out of existence and be bankrupted and have all its resources taken away and parcelled out in bankruptcy court proceedings to companies which you could use them better. But unfortunately, they have a red telephone link into their local government. And they ring that red telephone and say, save us. And so instead of going bankrupt, what will happen is the government will take taxes from this company and this company and this company and will pour them into this company to save it. It is a company which will be saved no matter what, no matter the circumstances of the marketplace. So in this kind of government rigged market, what will happen is this company will grow larger than it was before because of all these sucked in resources from these other companies, and these companies, because they've had all these taxes taken out of them, will get smaller than they otherwise would have been because of all that money that's been taken away that they can't use to reinvest in themselves. And that's the situation we end up with in one of these kind of rigged... Oh, I lost one of my companies completely. Actually, they lost so much money they went bust. Okay, and they're too small to worry about for the government. So now what we've ended up with is a very large moribund company. We've got two companies which have shrunk, which could have grown, and this one's gone completely bust because it had so much tax taken out of it. So the basic consumer over here, I'll have me representing society there, is unhappy. Now, that is the reality of what actually happens in the real world, but how does that transfer to our free float discussion? Well, what can happen with one of those large companies is the exchange. Let's say that this is a large moribund company here, and it has a free float of 50%. That's fine. That's absolutely fine so far. And then it goes bust because it's not very well run. It's not serving the market correctly. But what will happen is the government will come in and will buy up, let's say, most of those shares, and will leave just, say, 5% free. Remember, all the other stuff here was being held by other companies, and they're very pleased for the company to be bailed out, of course, because instead of their investment going down to zero, it's maybe even increased. So they would have been phoning the government as well. So what we have then is the government will own 45%, and that money will come from corporation taxes on other companies, all be printed money from thin air, which will decrease the value of everyone else's holdings of money. And so we end up with a free float of 5%. The exchange may agree to that. So the exchange may say, yes, we're happy with that. The only proviso is, let's say, within 5 years, you have to get it back to 25%. So what will happen is 4.5 years later, the government will sell 20% to get to the 25% free float to stay within this proviso, sort of not forced upon the exchange, but pretty much forced onto the exchange. And so you've got to be very careful of these companies. Why? Well, one, they would have failed, so obviously they're not being run that well. And also, we've got this tiny liquidity problem again. And the tiny liquidity, again, will typically mean high volatility. A lot of people swimming in a small swimming pool will start to get fractious. So there will be high volatility there. So lower liquidity tends to mean higher volatility, which tends to mean tempers get frayed. Okay, I think that's probably enough on free float. We've probably exhausted every particular avenue of discussion there. But remember, for all of your private financial training needs from London to Singapore and points beyond, contact us at the address below. And the next lecture, Lecture 8, which I was hoping to be Lecture 007, is going to be on bonds. See you next time.